We often confuse motion with progress. In product development, that looks like a perfectly automated assembly line shipping polished features on time, every time. But if no one actually buys those features, you aren't building a business. You're participating in product management theater. It is highly satisfying to close tickets and deliver on immediate user requests. That predictability keeps the engineering team happy and the stakeholders quiet for a quarter or two. But short-term execution predictability rarely survives contact with long-term market realities. This Venn diagram shows the trap. When you prioritize solely based on the overlap between what your engineering can build and what vocal users ask for, you ignore this third, entirely disconnected circle, what the market will actually sustain. Maximizing your engineering velocity without validating that market alignment doesn't ensure success. It simply accelerates your path to failure. This misalignment usually starts with a hiring decision. A pretty revenue startup brings in a highly successful enterprise product manager, expecting them to replicate their previous multi-million-dollar success. The operational habits kick in immediately. The mature product manager spends the first 2 quarters instituting complex scoring matrices and highly structured incremental roadmaps. Meanwhile, the core product still lacks raw, proven product-market fit. The financial trade-off here is brutal. The startup gains impeccable enterprise-grade processes, but it bleeds through its runway before the team can execute the messy, radical innovation required to survive. Strategy frameworks have zero inherent value. They are completely useless unless they are perfectly calibrated to the specific lifecycle stage of your product. This cascading flowchart maps the sequence of product planning. Market research sits at the very top. Calculating your service obtainable market, or SOM, identifies the realistic revenue cap for your product, forcing you to evaluate current sales staffing, competitors, and actual geographical reach. Running these numbers forces painful trade-offs. A rigorous sizing exercise might reveal that a highly requested passion project is financially unviable, requiring a hard pivot away from your original idea. Beyond market size, you also have to weigh environmental instability. This is the calculated probability that sudden technological shifts or changing customer preferences will render your product's performance metrics irrelevant. When instability is high, survival dictates your strategy. You shift your portfolio toward incremental innovation, delivering short-term improvements rather than placing massive risky bets. This image of early augmented reality hardware shows the risk of moving too fast. Let competitors absorb the architectural risk until a dominant design emerges. Surrendering the first-mover advantage is difficult to justify to a board, but it is frequently the necessary trade-off to avoid anchoring your entire product line to the wrong technological foundation. Once your market is sized and timed, you have to align the organization. The GLEE model breaks a 3 to 10-year strategic sequence into 3 actionable phases: get big, lead, and expand. This overwhelming volume of Netflix DVD envelopes represents the get big phase. Ride a market trend to build a foundational moat of users. Once you establish that moat, you enter the lead phase. This requires using the capital you generated to predict and capture the next wave of industry disruption. Finally, the expand phase. You leverage your established brand trust and economies of scale to move into adjacent categories or global markets. Executing this phased vision requires immense operational discipline. You have to stubbornly reject lucrative, immediate deals if they violate your chronological sequence and distract from the current phase. To maintain that discipline year over year, executives use forcing functions like the GEM model, which stands for growth, engagement, and monetization. The trade-off of GEM is severe by design. By selecting one singular metric to prioritize for the year, you inherently alienate internal departments whose pet projects don't align with that focus. This formula visualizes cost of delay, converting abstract feature points into specific revenue lost for every delayed week. This shifts the conversation to economic urgency. But without historical data, estimated revenue is subjective, resulting in executive gut feelings disguised as hard math. Deploying quantitative prioritization frameworks without first securing strict executive alignment on the overarching strategy doesn't solve disagreements. It just creates highly structured arguments. This scorecard maps the appropriate frameworks to the reality of the product manager. The tool you choose depends entirely on the stage of your product. For early-stage products, your primary risk is market viability. You use opportunity scoring and pursue radical innovation to accelerate the build, measure, learn loop. The goal is rapid validation of value, not polish. The trade-off here is accepting chaotic internal roadmaps and taking on heavy technical debt in exchange for speed. In the growth stage, the risk shifts to scaling. You deploy the GEM framework to penetrate your total addressable market and extract value from the product-market fit you just proved. The trade-off in the growth stage is sacrificing that early nimbleness. You have to start saying no to edge case user demands to standardize the core offering. The transition from the early stage to the growth stage demands that you replace raw velocity with ruthless focus. For mature stage products, the dynamic flips entirely. You employ the Kano model and strict strategic bucket portfolios to manage complex maintenance schedules. You are now managing a citadel. You have to balance the heavy funding required for incremental updates to your core revenue driver against the deployment of small, radical scouting parties looking for disruptive threats. The trade-off at maturity is accepting a slower overall feature velocity and high bureaucratic overhead. That is the cost of protecting a cash cow product. Frameworks themselves are not strategy. They are simply diagnostic lenses that help you view your current constraints. The ultimate mark of product leadership isn't fluency in every available framework. Instead, it is the discipline to select the single tool that completely neutralizes your product's greatest current market risk.